All right, for those just joining, welcome. Welcome. Just gonna do a slow start here just to let some folks join. And okay, so let's go ahead and do an intro and allow some folks to join as we get into the core of the content here. Today we're going to be talking about agile costing, right? Specifically around the subject of CapEx and OpEx and time tracking. And this is often a topic of contention in organizations, right? Getting the right time accountability from an organization, some of the complexity that goes may have been carried over from non-agile or previous working things. And, you know, can agile or taking the agile approach to it start to simplify that, right? So if this is your first time joining one of our webinars, my name is Robert Shaw. I'm an enterprise agile coach and trainer here with Clearly Agile. Have been in the software industry for 20 years and have a specialty in scaling agile at scale, scaling patterns, and modernizing agile testing. Right. So we're going to start out with just a quick poll. All right. So on your screen, you're going to see a poll pop up really quickly here in a second. All right, and there we go. So how would you or your team members describe your time tracking process today? Either from a not tracking, it's super easy, all the way up to it's complex and miserable. All right, so if you see that pop up on your screen, go ahead and pick an answer. It looks like it's sharing now.
Rob, it looks like it's showing just the results. I don't know if you're able to go back for the option to select.
I appreciate that. I was actually wondering if it was relaunch poll.
There we go.
There we go. Apologies, I hit the wrong button. All right, going to be closing that out here in a second. Just waiting on a few more responses. All right, so let's go ahead and close that out. Go ahead and share the results. All right, so in something like this, typically we see, I'll see a spread of, right, there's usually two polls. It's really super easy or it's not too bad. Sometimes in organizations that ventures into it's complex, I don't even understand why we do it, to, right, we spend more time tracking time than we do doing actual work. Right, so it looks like from the responses, we get probably leaning a bit more on the super easy or a little complex, but not too horrible side. But what we're going to get into will still possibly be beneficial in making it even easier. All right. There we go. Okay. So when we say what is an agile approach to CapEx, right? What are we talking about, or starting to set the stage for it? See, when we're tracking time and even trying to track that time back to our capital expenditure or operational expenditure, a lot of the processes we have in today have been born from an older way of doing things, more of a traditional project management mindset, right? And a lot of those had to do with tracking activities where people were distributed across multiple teams, multiple projects. And that complexity carries over even today, or doesn't carry over well today from an agile team structure or an agile team environment. See, at the root of this, Agile itself is a very different organizational structure on how we handle teams and how we organize around the work, and oftentimes conflicts directly or complicates the traditional time tracking process, right? It often gets in the way, and we wound up, possibly leaving money on the table or capital expenditure on the table. And this is going to just explore, right? Can a lean agile budgeting approach provide an alternate solution that simplifies the tracking and leads us with much better outputs or outcomes, right? So it's hard not to get into this topic without putting a slide like this up there, right? You don't see too many webinars on this because, frankly, it's a very messy topic. Lots of knots, lots of things to unpack. Certainly long histories in some organizations of process doing it a certain way. So what this is going to try and do is try to pick one thread through that to be able to go end to end into an agile approach for solving this. All right, so we're going to take a look at a little bit around CapEx 101. What is it? Why do we do it? What benefit does it have to the organization? What drives some of that passion and fervor around these extreme time tracking processes that could be there, right? What's behind it? Take a look at how company preferences actually factor into this whole capitalization topic, right? No two organizations are going to approach this the same exact way, and that's okay. And then lastly, we're going to take a look at the most common lean agile approach alternate to traditional time tracking. And there are organizations that are certainly doing it this way and having, using it as their primary process over what we think of as traditional time tracking today. So jumping in, right, there are two main expense buckets, right? So we're just going back to its simplest element. There are two main expense buckets. The work that we do is going to fall into either capital expenditure or operational expenditure, right? Capital expenditure being, right, the R&D cost or the cost of bringing a new feature or something of value to the market, right? And it includes everything that it takes to develop that new future of value, future being the key word there, right? Operational expenditure or operational expenses, that is your normal day-to-day cost to run the business with what you have today, right? And those two buckets can be handled very differently from a financial aspect in your organization or in an organization, right? So what's the difference, right? So CapEx is anything that falls into the cost of developing things where the full value of it cannot be realized in that revenue year. In other words, a new product, a new feature, a new capability or significant capability in the market, right? The sunk cost of the R&D, the development, the building, the launching, the marketing, and the things that go into that, right? The revenue from that cannot be realized for until some time in the future, right? So the impact to that cost is typically spread out over years or amortized over years by the organization, right? It's something, a tool mechanism that allows them to invest in growth while deferring the cost that actually took to build it over time until the revenue stream can match or keep up and they can start recouping that investment back, right? It is the mechanism or one of the primary mechanisms to allow companies to invest in that future growth by being able to defer the people, time, R&D expenses, et cetera, right? Where OpEx is a little more straightforward, right? This is the as-is business today, not including those R&D and future development costs, right? Running the equipment today, the servers today, the people it takes to maintain, operate, and support all those business operations today. Right. It also gets into software licensure, material costs, rent, utilities, et cetera. Right. So if you think about it just very simply, one is future growth and being able to invest in it. The other is the operational cost of keeping the doors open. Right. So without capitalization, right, a company, just say a small company, all right, using smaller numbers here just to keep it straightforward. A company currently making $5 million today in annual revenue has an operational cost of $3.5 million, resulting in a profit margin of $1.5 million. Right, like I said, just keeping it very simple today. If that company wants to grow, right, so find me a company that doesn't want to grow, right? That's kind of one of the main points of an organization is to grow and produce more to make more money for investors or the owners, right? So they want to reach that goal of 15 million a year, right? But in order to do that, they need to be able to reach into a new market, right? They need to tap into something they don't have today, right? The estimated cost to do that is about 2 million additional a year to build that software, right? If they just looked at their profit margin, right, they're $500,000 short, right? That's not achievable for them today to be able to make that investment to growth, right? So without capitalization, right, they're going to be bound by their current rate of margin or profit to how quickly they can get to go there, right? So, you take a look at a couple of questions. Would the new software generate enough revenue in that first year? Right? The answer to that is no, right? Maybe next year, maybe the year after, right? So you start playing out this scenario that, right, using capitalization helps, right? So in that first year, right, the capital expenditure amount, right, they take that and they invest that 1.7 million, but in that first year, that new revenue that comes back in is zero. They are able to expense or amortize the cost of that $1.7 million investment over the future years, right? Because we see in year two, right, they still have a $1.7 million output, but the revenue is still 500,000, right? In year two, they can still take advantage of that capitalization to offset the cost of developing that product, but revenue is now growing, right? And you see in year three now, right, and looking at year four, the product has entered the market, it's getting traction, it's getting sales. The revenue is starting to outpace the capital amount needed to produce. In fact, because the product is solidifying in the market, the capital expenditure is actually going down, right? So by year four, right, revenue is outpacing. The amortization is probably ending, or they're able to pay back on that investment. And the revenue that's generated is now enough to support the operational cost. Right. So this is a simplified version of it. But what you could see, what this buys an organization is time for growth, time to invest in growth, right? Which is why it's such a focal point on making sure that that time tracking is accurate and going into those right allocation buckets, right? This is a financial strategy where they don't want to leave that money on the table unnecessarily, which is why we see such a prominent focus on it, right? Because what it boils down to is the company's bottom line, right? What the valuation of the organization is. And one of the most common terms you'll hear for that, or the way investors are measuring the financial health of a company, is EBITDA, right? So you may have heard the words EBITDA, you may have heard the term before. But what's behind it, right? So EBITDA stands for the formula of calculating earnings before interest, taxes, depreciation, and amortization. Amortization, quote unquote, CapEx. right? So they can take that number and they use that to count the value of the organization, right? The ability to remove that CapEx investment helps, right? Often this will go as far to, usually calculates a large number. So often we'll see it reduced or produced down in something referred to as EBITDA margin, right? Where the EBITDA is divided by the revenue to produce a margin number, right? A percentage number, right? And again, in that calculation, right, operational expenses are included, right? So the cost of doing business today, but they get to take advantage and leverage things that fall in that capitalization expenditure, and pull that out of the calculation, right? So as an employee, right, or as anybody working on a project that's tracking time, right, the big question is, why does this matter to me? Why does this matter to you, right? And I think knowing that helps, right? Because, if they're playing the capitalization game well, and we're doing a good job at making sure we're accounting for those dollars spent, right? What we get is that, the output of that is a improved or better EBITDA margin score, right? And if you take a look at the stuff in that column on the right, we see all the things that we want, right? Especially getting down to the end. The valuation of the company rises in the market. Yay. Happy investors, happy owners. We see funding options increase, right? Typically, we see compensation options also increase, right? A company that is profitable, good EBITDA margins, usually has better reward structures in place for employees, right? You usually see better bonus structures in place for employees. You also see more support for hiring and expansion, right? The margins are there, the margins are good, right? So we can support hiring, we can support expansion, right? And typically the end of that, right, what we see is personal growth and mobility within organizations starts to expand, right? It enables growth, right? If you take the other side of that, right, and maybe not a good capitalization strategy, or the system's not in place for optimizing tracking capital expenditures, right, which can help lead more operational budget on the table than should be, right, which helps lower that EBITDA score, right? You start to see the negative effects, right? So you see limits in expansion and mobility because, right, we also have limits in compensation, bonus, rewards. A lot of times when that margin goes down, you start to see staff reductions, right? Because they have to start closing up that gap. You see decreased funding chances, which limits the growth in the organization, right? So tightening the belt, so to speak, right? So when it comes behind this simple activity of tracking time, what is really the why behind the why? It has to do with margins, growth, and the ability for the company to expand and support all of the people that are working within the company, right? It factors into one of the most critical measurements an organization can have, right? A score that they want well, right? So if, we take that an organization wants to optimize their capitalization strategy, they don't want to leave that money on the table, right? There's a lot of questions about what can be claimed and what cannot be claimed, right? And understanding that either as a manager, director, a leader, or even just an employee, right, can really be beneficial in helping the company in success, right? So if you're in the development space, and I'm assuming most people on the call are in development, maybe incorrectly, but most of the work that we do in development is CapEx, right? If we're working on new feature enhancement or new feature development, right? So new feature work is a capital expenditure, right? When tracked correctly, right? We just talked about that. It impacts the EBITDA scores positively. When not, it is negative, right? So the cost of running a new application, new application development, right, can be millions, right? If not tracked correctly, that could be millions of dollars in the wrong bucket year over year, right? If we're not paying attention to this and looking at ways to optimize it, right? right? In just one organization that I worked with recently, right, what we came to the realization at the end of just doing a little couple simple exercises is that 50% of what they were tracking as CapEx was actually correct, right? Meaning they were leaving 50% on the table, right? That's not a good outcome when we're looking at, especially in the growth stages, right? So if you just go back, right, and we look at the financial accounting standards board categories, right? Loosely, this is how it breaks down, right? So you have preliminary work, right? So this is, right, the key there is anything that is before funding, right? So depending on how your organization handles funding or go for a product or project or initiative, right? Anything that is the vision, the initial market analysis, possibly some initial road mapping, right? Feasibility, go, no go, right? Is this the right market? Is this the right solution for the market? Do we want to do this, right? Including maybe some early prototyping, right? So anything that is before funding is going to fall into that operational category, right? It's the cost of doing business, and market research, market research, product feasibility, right, is part of that preliminary strategy, pre-funding strategy, right? But after funding, right, anything that falls into the creation of value add that does not exist in the market today is going to fall into that capitalization category. It is in that CapEx category, right? Once that value add is produced in its entirety, right, or in its usable form where it generates revenue post implementation, right, and usually some leeway on the other side of that, right, to support that as it's rolling out. But once it's an established product in the market and has been released and customers are using, generating revenue, it moves back to OpEx. So release to the customer, support and maintenance, possibly minor enhancements or tweaks that really don't have a revenue impact could be considered in the OpEx category, right? So what you have is the bookends, right, of OpEx, of, right, feasibility, market analysis, release to production and support, which fall into operational. But that ground in the middle is fairly broad, right? And if we take a look at that just from an agile development perspective, right, simplified version of it, right, the product vision, the product roadmap, the what understanding, do we want to build this, in the operational category, right? But the stuff that is in the middle, right, once a team starts sprinting, right, the design, build, test, develop, release, integrate, etc. work into that sprint over sprint over sprint is capitalizable, right? So all of that work that most of the teams are doing sprint after sprint is capitalizable work, right? Moving it out the other side, production maintenance, the what, right, post implementation, right? So I think you guys get the picture of that. Right, so taking a look down into some of the agile, how some of the agile events, right, a little more specifically fall in there. Right, release planning activities, right, as long as that work is on the backlog and approved, right, that part of that work can actually be capitalized. PBI refinement, right, actually the time spent doing the refinement of the store feature, right, it's in the design, it's part of the design, build, and teamwork to be able to produce that. The sprint planning, the daily scrum, sprint review, retrospective, right, that's in there, time spent. Artifact creation, right, if you're doing anything at scaling, PI planning, scaling events, feature story creation, etc. Inspect and adapt activities, fair game, right? And we may hear different versions of that depending on organization. We're going to get to that in a second, right? So sometimes you see organizations like, well, we're going to include this, but we don't want to include the Scrum Master time, or we don't want to include the product owner time, right? So we're going to get into some of the why behind that here in a second, if you're hearing that, right? But in general, right, these would fall into that category of capitalizable. The organization could take that, right? And then the post-implementation support again, right? So playing off of that, right? So sometimes in an organization will see, right, we don't want to capitalize these things, right? This falls into whether or not the organization is adopting a common approach to capitalization, a conservative approach, or an ultra conservative approach, right? Generally the three buckets that are out there, right? Now, this is usually a choice that the organization makes. Now, they may be getting that advice from a financial advisor. They may be getting that advice from an accounting firm. That may be driven from the CFO in the organization, right? Typically, there is a capitalization strategy that's in play, and some organizations prefer not to capitalize the full sum of everything that is capitalizable for various reasons. All right, larger than this webinar can get into. But just to kind of state it to the extreme is there are organizations out there today that do not capitalize any of their development work and throw it all in the operational bucket, right? That is part of their financial strategy, right? So what you have is this line of what is potentially capitalizable or valid for capitalization that also is the company or organization has, right? They get to choose which approach, right? And that tends to fall in one of those three buckets that are up there, right? So common, right? All the activities from the previous slide, we're going to squeak out as much capitalization as we want from it, right? A lot of times you'll see that play happening from a startup or a new organization looking to aggressively grow to a certain size as rapidly as possible. It's on the table, track it all. We want to capitalize that because, right, we want to get to a certain valuation point, certain size, right, for the next round of funding, the next round of investment, right, whatever. A lot of times an organization can try to balance some of those costs, right? And they want to subtract out the times for, say, retrospectives or non-team meetings events, right? So we may see something like, we're going to capitalize based on 80% of a team's time, factoring out 20% for company meetings, email, non-work hours, right? We're going to standardize a percentage of that time. And then also we're going to subtract time from like team retrospectives, right? So they may allocate a smaller bucket as a full-time employee, right? We're expecting you to do capitalized work for 80% of your time and 20% of the work spent on organizational time, right? Just part of their strategy, right? Some companies a little bit more, some companies a little bit less. Usually this is a choice driven internally through the financial organization, right? Ultra conservative, right? So here, they may choose to capitalize the cost of development work and testing work, but they may choose to put some of the product vision and product road mapping type activities, even post-funded, into the operational cost, right? I've heard mixed reasons why they would do that. A lot of time as they look at it is they don't want to get red flagged from an audit for putting too much in that bucket due to the size, scope, and scale of what they're doing. I'm sure there's various other reasons to go into that one. The root behind this that I really want you to take away is understanding not just why you're tracking time, but just stepping out a little bit into what is our strategy that the organization is looking for. Because if you understand the strategy and how that fits into what they want to capitalize, then that lets us look at what can we extract from the Agile process to help you maximize even just the parts that you want to do, right? If it's common, we're going to figure out how to maximize the whole thing. If it's ultra conservative, let's make sure that we're not leaving money on the table, specifically on the parts that you want to extract for capitalization tracking, right? So in general, right, these labor categories are on the table for tracking cost, right? And again, depending on the strategy, we hear mixed things coming back. Sometimes these categories being off the table is just not understanding that they are, right? Sometimes it's because it does fit back on the strategy, right? But the salaries, contract labor costs of anyone who directly designs, builds, tests, documents, or integrates a feature, right? You can take that cost of their salary, their hours, right, in full if they're allocated to a capitalized project. The cost of product management, product owners, et cetera. If they are involved with delivering new value to the market, right? Their cost for doing that is a capitalizable expense. They are contributing to delivery of new value. Coaches like myself, right? A lot of times we fall in the operational bucket, but actually we could, right, be capitalized. Coaches, scrum masters associated to the value delivery process of new work, right? Just as a side note, sometimes we see the coaches, scrum masters more allocated as a percentage of time than tracking direct work. But if they are working on teams delivering new value, that time is on the table, right? As is, and this one gets a little bit more tricky, non-technical team members when they are associated to delivery and integration, right? So architecture, DevOps, and operation time, when it's spent on things that are producing new value, right? Day-to-day stuff, not so much, right? But really, it's good to know for each of the labor categories how much is and when is it and when is it not, right? So from a team perspective, product manager perspective, even a scrum master perspective, if they're on a team dedicated to new features that deliver new value, future value, fair game, right? Some of the other roles, a little more so when they are, right? A little more care needed for when they are and when they're not, right? So if we were to look at that, right, traditionally, a lot of times we see people tracking time to project buckets, right? And we often see in the Agile world, how much time did you spend on a story where that story tracks back to a project code, right? And at the end of the day, developer can go through, I did this task on this story, which goes to this bucket at the end of it. And they go and they repeat that 20, 30 times for whatever they worked on during the sprint, right? That is often a holdover from traditional project mindset where people may be working on more than one project, right? When it transfers over into the Agile space, this concept of shared responsibility on a team where you may be working shoulder to shoulder with people and not necessarily a single story on a single project, right? Gets a little tricky when you apply old thinking to it, right? And like I said, that's that twisty ball of yarn with knots that I was throwing out in the beginning, right? Because sometimes with organizations, it takes a little bit to untangle that thinking. What I'd like to focus on this next section is, okay, if we didn't have to deal with that, right, to suspend disbelief there for a minute, right, how are people doing this in a lead Agile way actually approaching this, right? What does a positive solution look like versus getting hung up on the untangling the negative side, right? And what that gets to is the simplest way to track CapEx is to allocate the percentage of the time that the team spent on the sprint for capitalizable items versus operational items, right? If you remember, the fundamental difference of a Scrum team versus a project team is Agile is team-centric, and we form teams around sticky teams to be long-standing delivery teams where the work funnels into them, right? It's a paradigm shift from traditional projects, right? And in order to accomplish that now, because we have a sticky team that stays together and they're operating on a cadence, right? Whatever your sprint cadence is, right? It becomes very easy to calculate the fixed cost or potential fixed cost of the team, right? So accomplish this, right? We need to be able to calculate the cost per sprint for a team. We also need an estimate of complexity, right? For the backlog item being completed, right? And we need a way to identify whether that work is CapEx or OpEx, right? What bucket does it fall in, right? Either by parent feature or some other designation in the system, right? But rather than going item by item, if we have those three things, what we'll be able to calculate is a dollar amount per sprint into those buckets, right? And actually can, with a little bit of work in most systems, track that back to either a root project or even a feature allocation, right? So the underpinnings now, even to get to higher numbers, become a little bit easier, right? So taking this a step further, right? An agile team, for the most part, is considered stable, right? If we are have a team formed and we are doing sprint after sprint after sprint, while we may have occasional team memberships, for the most part, that team is stable and sticky, and we know that it's not going to change sprint over sprint, or at least the core of the team is, right? So using that, right, either using actual salary cost or blended flat rate, which is also a valid option, or percentage of agile salary cost adjusted, right? So 80% of the agile salary, right, will give us a per day cost for that employee, salaried employee, right? The actual daily salary cost, is that not adjusted? Blended flat rate could be sort of the average flat rate per person on a team, right? Which is usually your accounting organization can give you what your blended flat rate is, right? But if we have that number per day, right, that per cost, either calculated individually or blended flat rate, right? The cost per person per day times the daily rate times the work days in the sprint will give us the team cost per the sprint, right? Now just let that sink in, right? The blended flat rate a day times the number of people times the number of days in the sprint will give us our run rate for that team per sprint, right? So just taking a look at that, right? If you have, right, I'm just using annual salary up here, right? Kept the numbers very, very simple, right? But with an allocation, right? We see at $100,000 a person with an 80% allocation, our salary is $80,000 a year adjusted, right? Their capitalized salary is $80,000 a year, adjusted salary, which gives us a daily rate of $219 a day at 14 days in a sprint. My per person sprint cost, right, $3,068. My total cost for the team per sprint is $12,274, right? I know that if nothing changes on this team, sprint one is going to cost me $12,000. Sprint two is going to cost me $12,000. Sprint five, if nothing changes on the team, is $12,000, right? This is part of what makes this work in agile organizations is team becomes a repeating fixed cost, right? Certainly there are times where it's adjusted for vacation. Certainly there are times where we may add a team member and we have to recalculate it. But at any given point in time, right, those are few and far between, and we have an average run rate or fixed cost rate for the team that is stable, right? We are not moving people from project to project. We have a core unit, a delivery team of all of our capital expenses, right, valid capital expenditures in there, right? The question is not what the dollar amount is. The question is how much of that $12,000 in that sprint went to capitalized costs versus operational costs, right? The math changes, right? So if we take a look at this, right, here we have Team Fantastic, right? And this is just a typical sprint for them. They delivered, 20 points of work, right? So what we have here, if you're not familiar with pointing, is an estimate of the complexity of work, right? 5 being bigger than a 3, 3 being larger than a 1, right? It's effort, it's complexity, right? A lot of times on a Scrum team, it's not a person doing a user story, right? We may have more than one person contributing to that, right? They may be paired up and working together on it, right? So what we do is rather than looking at the number of hours per story, we look at how do we divide the effort, the total sum of the effort, into capitalized and not capitalized, right? So here in that 20 points, 13 of the points that the team did was on capitalizable work, right? It's a story that could trace back to a feature, initiative, or funded item in the organization that is developing future revenue potential. Where 7 points of that work, right, is something that was operational. Let's call it break fix or supporting something in the field that's already been produced, right? For their sprint, right, what they now have on that fixed cost for the team is a 65% of capitalized expenditures versus 35% of that team cost went for operational expenses, right? So if we take that team run rate, right, $12,000 and 20 points in delivered in the sprint, 65%, 35% CapEx, OpEx, right? What we have is, if we were taking the true value of that, right, $7,900 of capitalizable expenditures versus $4,000, $4,200 of operational expenditures, right? Right, that is easily calculatable. There are reports that can be generated for most ALM systems to get you there, including traceability back to codes or traceability back to features, right? But what you now have is money that may have been left on the table trying to calculate this down by task, right? We're actually now capturing something a little more true to the work that was done to optimize that CapEx dollar over that OpEx dollar expenditure, right? It actually tends to be more accurate to the effort that went in, because people inherently are not good time trackers. They tend to under or forget or miss putting something in or key it in, right? This sort of takes that out of the picture a little bit, right? So if we were to take a look at this, right? So one of the questions that commonly comes up is like, oh, well, what if we had features? Well, that's okay, right? If you take a look here, right, this is actually a comparison of for this feature, right? Here in this example, this organization, right, based it on a real organization, changed the numbers and kind of simplified the names there. But they actually put PM time, architecture time, and IT time directly against the feature itself, right? So we have real numbers from the roles going on to here. But if we look at the team time, right, we know that the stories that rolled up under this feature, right, say this feature had, I don't know, say this feature had 6 or 7 stories underneath it, right? And those were spread out over 4 sprints, right? What we see is each of these features were delivered, right, at 37 points, right? Points delivered non-cap was this, right? Based on the capital percentage of the sprint, right? What we have is $9,673, right? So whether it's done story by story or whether this needs to roll back up into feature, right? Or whether you call it features or whether you call it epics, right? Your glossary. But if you need to roll it back up to a parent tracking, right, for longer term, right, that still is actually possible and uses just a very similar version of the math. In fact, in this one here, this one here is actually even factoring it in across multiple teams, right? So what we have is a team of teams cost up at the top, right, and my team of teams cost at the bottom for each of the sprints, and how those percentages of points are breaking down into the capital or non-capital costs, right? So it can be done at the story level, it can be done at a feature level, it can be done at a feature level distributed across multiple teams, right? Just another view from a scaling perspective, right? And very, very similar concept, but we have the teams now taking in multiple features, right? And we can see here that the core math doesn't necessarily change. What we're doing is we're doing the roll up from the story work completed in each sprint back up to their parent features and applying the same calculation to get my feature capitalization versus operational per feature in each of the sprints with a sum total at the end, right? So we have the total team cost, we have the capitalized cost per feature to deliver the entire thing during this cycle, as well as the operational cost broken down by team, right? Once you have one of the patterns, putting the systems in place, right, is, you know, here you can simply be done with a spreadsheet or within your own ALM tool. Most tools can handle this, right? But what we have is a different way to get to those numbers faster, capitalizing more of the teamwork itself. All right, so I'm going to hit Q&A here in a second. But that was it for the general walkthrough from the cost, right? So I'll hit the Q&A questions here in a second. If before I forget at the end, just wanted to talk about 2 future events coming up. So one, we're going to be running a Scaled Agile certification training. So if you're considering exploring SAFe, or you're already heading down that route, we're going to be running our Leading SAFe SA certification class June 13th and 16th. That's a virtual class over 4 days. If you like the webinar series, up next at the end of June, our very own Om Patel is going to be walking us through a little bit of Azure DevOps for Agile, right? So breaking down a very common tool and the utilization of it. So I think the date on that is June 30th, and you'd be able to register for that on our website. All right, so for the questions. All right, just give me a second here to read it, because I know you guys cannot see these. What I've seen. All right, what I've seen, the contractors are almost every time considered as CapEx, while full-time people OpEx. Full-time people need to get paid salaries regardless. Interesting. Okay, so I think I have the question. I'm not quite sure who asked that, right? But what I've seen is contractors are almost every time considered as CapEx, while full-time people OpEx. So what's interesting is a lot of times your contractors are, like the first half of that tends to be true, right? Well, in new software development, right? So a lot of times contractors are brought in to offset, help out, staff up around a new project or initiative that's been funded. The majority of the time why you may be seeing that is it's usually a capitalized project, right? So that part of that is true, right? Not 100% of the time, right? So for example, if you had a contractor who was brought in to handle support, right? So you stood up a support Kanban team, right? That, while contractors, the cost of that, because it's supporting a product which has already been released into production, is going to fall into the OpEx bucket, right? So if you're just talking new development, yes, the first half of that statement is true. What is curious is, right, full-time people need to be paid salaries regardless, right? Those salaries are an operational cost, right? So yes, right? So the question there from a financial strategy is, if that salaried full-time employee is doing work or is on a team doing capitalizable work, right? They can, right? Just because they're getting paid a salary, right? That salary, or the portion of their salary they're spending on that time, can be capitalized, right? So that may be money on the table there, right? And that's often where we see with full-time employees, that 80-20 strategy, where 80% of the time for the salary employee, right, that's potentially capitalizable work, but we're going to take 20% and just lock it into OpEx, right? That's where you usually see that percentage strategy come in. But what I would be curious about is understanding, right, is there a different reason behind why they're always just putting full-time employees in OpEx, right? If they're just doing work to support the day-to-day operation, yeah, I get it. But if those full-time employees are doing CapEx project work and they're on a team full-time doing capitalized work, those are dollars that are on the table and valid. So it may be an internal strategy, or just maybe money not, for whatever reason, bad advice, and they're just leaving money on the table, right? So something to look into. All right, second one, can you please explain how throughput accounting, theory of constraints, can help with Agile accounting? So actually, I don't know if I can answer that, because I am not as familiar with throughput accounting there. So actually, you can reach out afterwards. Connect back through the website. I'd like to know a little bit more on that, but I don't know if I want to touch that, because I'm not familiar with that, what's behind that theory, right? So I might recognize it when I see it, but off the top of my head, I actually don't have a good answer for that. All right. So my apologies, wish I did. All right. So with that, thank you for your time. Thank you for attending today. And I hope to see you at either future events or seeing you in one of the certification classes in the future. But thank you. Hi, Susan. I saw you hanging out afterwards. I don't know if you're hanging out for a question or just leaving it on because you're doing other stuff. Uh, if you have a question, I did put the ability to unmute your microphone and ask. So if you have a question, feel free to ask it.